Concern over a slower growth rate for China has rattled global equities after a recent stream of poor economic data. Companies such as General Motors, Boeing and Caterpillar have significant investment in China, which represents a $300 billion market for US firms. Joining us to discuss the implications of a slowing China is Joohee of Mirae Asset Global Investments. Welcome, Joohee.
Thank you.
Joohee, could you tell us, broadly speaking, how might a lower economic growth rate for China affect gains for global equities over the coming year?
Now, for the new Chinese government, it's very important for them to change the growth engine. That means this transition is going to be about the consumption rather than export investments. So I expect for the first half of their period, which is 10 years, I think they will get rid of all the they will try to get rid of all the problems like such as shadow banking or the overcapacity, idle capacities, and so on. And then maybe second half of the period, they are going to show us the improved economies in more efficient way. So I think some companies who are exposed to their the industrial growth, such as commodity plays or infrastructure-related ones, could be not positively affected from the trend for a few years. But this transition is not necessarily negative from the long-term perspective, though, because the taking care of the quality of the growth is very important. And then it's positive from the long-term perspective.
Okay. Now switching to a more stock-specific question, many Chinese internet firms have rallied very hard over the past year, and there's growing concern over the valuation of those firms. Is that a concern that you share?
Especially China internet sector is very unique. We have to be mindful of the fact that China internet sector is protected by, especially local companies in the internet sector, is protected by Chinese government. That's first. And then secondly, the Chinese people, they are much more comfortable with Mandarin rather than English. So if you look at top 5 websites in China, it's all local brands. But this is very, very different from India case. For example, in India, all the top 5 websites are all global brands. That means so this is a very good environment for Chinese internet sector. And then the plus, in the past, the China internet sector is mostly about the expectations. But now they are going through the sweet spots, which means they are starting to make money. And they show us the numbers in terms of monetization. So it's not just bubble, just like we talked about in the past, especially for high quality names and good names. So maybe some small companies who are listed in Nasdaq or in Hong Kong or in mainland China, they because of the recent rally, if their quality is not very good, then there could be some bubbles in it. But especially for high quality names like a Tencent, then I think it's not just bubble.
Okay. Now, aside from opportunities amongst internet stocks, for someone with a longer 5-year time horizon who believes in the so-called Asian growth story, how might they best access that, or how would you go about investing to access that?
Okay, so besides the internet and e-commerce I just talked about, then I think the tourism it will be one of the best the sectors we have to exploit, because now it's all about the consumption, right? But even among the consumption, from my experience, we have to focus on underpenetrated sectors. And then if you think about the underpenetration of the Chinese outbound travelers, which is less than 5% now, then we can see the really big potential of growth. So going forward, it's not about like top-down allocation. It's all about the bottom-up approach. So like tourism or internet or high growth the stocks will be still promising despite some weakness and volatility of index.
Okay, thank you very much, Joohee. That was Mirae Asset Global Investments Portfolio Manager Joohee, and I'm Jane Searle for The Street.